Hi traders, in this short video, I will take a quick look at US Fed rate hike and what emerging trends should you prepare for in 2016. As you already know, we had a first historical rate hike in nearly a decade, and this was the first rate increase in June 2006. It's important to remember that interest rates remain extremely low even after this rate hike. The Fed raised its key rate from 0.25 to 0.5%. It's good for the economy because it also shows how far the economy has come since the Great Recession, which ended in 2009. Employment back then was 10%. Now US is close to full employment, which is around 5%. As I have already explained, a step-by-step gradual hike should ensure stronger dollar through 2016 with occasional retracement as in every trend. My opinion is that markets will surely be happier with a midterm step-by-step hike rather than a hike each meeting. Definitely it's good for savers because if you put money in your savings account, you will slowly start to earn interest over the next couple of years as rates start climbing higher. Savers haven't earned any interest since 2008. Mortgage rates could start climbing, so home buyers pay attention. A typical rate on a 30-year mortgage is 3.9%. It's low because in 2006 mortgage rates were above 6%. And this Fed historical move was led by Janet Yellen. Miss Yellen said that she was drawn to economy by submission of morality and social responsibility by his husband, a Nobel Prize winning economist, Mr. George Akerlof. So she definitely didn't need to wait too long to raise rates, and because if she did, she would risk sparking another financial bubble. So now Yellen may go down as the greatest central banker in near American history. Time will definitely tell. Now again we need to say what emerging trends should you prepare for in 2016. First thing is slowing GDP growth in China and shadow banking risk due to their weakening property market. So expect more pressure on hard commodities prices as China shifts from malinvestment in the construction industry to consumption and services-based economy. Dollar-denominated debt in emerging markets is a wild card risk. The IMF is very concerned about the risk, especially if the dollar strengthens again after future dollar Fed rate hikes. It's a double whammy effect, making it far more expensive for emerging markets debtors to repay those types of loans in their weakened local currency. Currently there is $70 trillion in these loans out there in emerging markets, and that's the equivalent of the Eurozone GDP in size for comparison. If this starts to default, expect another global financial crisis. And definitely guys, potential equities crash. The last two US equities crashes occurred within 7 years of each other, from 2001 to 2008, and we are maybe heading into overvalued equities in the US with deteriorating earnings per share. Some global investment banks are sounding warning bells that the next crash is very near. But do not be feared by the global economics. You're able to read about every important factor from the world of trading to most important economic events. As always, we are here to make your trading life easier. We got you covered.